The fundamental objective of a business development company is the generation of current income through debt investments, which is then distributed to shareholders to maintain compliance with Regulated Investment Company (RIC) tax status. For Ares Capital, the income statement over the last 4 years reveals an interplay between portfolio scaling and interest rate sensitivity. Total investment income has demonstrated a significant compound annual growth rate (CAGR) of 14.4% between 2019 and 2024, a trajectory largely facilitated by the expansion of the underlying loan portfolio and a favorable yield environment. Ares Capital's revenue is primarily derived from interest income on its debt investments, supplemented by capital structuring service fees and dividend income from equity co-investments. In the fiscal year ended December 31, 2024, the company reported total investment income of approximately $3.123 billion, a substantial increase from $2.870 billion in 2023 and $1.652 billion in 2022. This growth was driven by an increase in the average size of the investment portfolio, which reached $28.7 billion at fair value by the third quarter of 2025.
Interest income remains the dominant revenue driver, accounting for the vast majority of the $782 million in total investment income reported in Q3 2025. However, as the Federal Reserve began to stabilize and eventually lower base rates in late 2025, the weighted average yield on the portfolio began to show signs of normalization. The yield on accruing debt and other income-producing securities at amortized cost was 10.6% in Q3 2025, down from 11.7% in the same period of the prior year. This decline reflects the floating rate nature of approximately 71% of the portfolio, where interest payments are typically tied to benchmark rates, such as the secured overnight financing rate. Historical financial performance, 2021 to 2025. Total investment income. Ares reported $2.689 billion in 2021, which dipped to $1.652 billion in 2022 before climbing to $2.870 billion in 2023 and $3.123 billion in 2024. As of the trailing 12 months ending Q3 2025, income stood at $3.024 billion. Interest income. Interest earnings rose from $1.448 billion in 2021 to $2.275 billion by 2024. Net investment income, NII, trended from $1.403 billion in 2021 to a peak of $1.595 billion in 2024, settling at $1.363 billion for the TTM period ending Q3 2025.
The transition from 2024 to 2025 highlights a critical shift in the BDC earnings cycle. While total investment income grew, net investment income, or NII, began to flatten as interest expenses rose and yield spreads tightened. The net profit margin, which stood at 57.48% on a trailing 12-month basis ending September 30, 2025, reflects the increasing cost of liabilities in a stabilized rate environment. Operating expenses for Ares Capital are primarily composed of interest expense on its debt obligations and management and incentive fees paid to its investment advisor. Interest expense increased to $659 million in 2024 from $530 million in 2023 and $372 million in 2021, mirroring the rise in benchmark rates and the company's strategic use of leverage. Despite these rising costs, the company maintains a strong operating profit margin of 93.09% TTM, illustrating the efficiency of its external management model and the scalability of the Ares platform.
Management fees are a function of the total assets, while incentive fees are tied to performance, creating a degree of alignment between the advisor and the stockholders. In 2024, approximately 95% of Ares Management's total fees were derived from perpetual capital vehicles or long-dated funds, providing stability to the management structure. Ares Capital's ability to maintain a BBB credit rating from S&P Global and Fitch allows it to access the unsecured note market at competitive rates, which is crucial for maintaining a favorable spread over its cost of capital. Ares Capital's balance sheet reflects its status as a market leader, characterized by a massive and increasingly defensive investment portfolio. As of September 30, 2025, total assets were $28.25 billion, with the investment portfolio at fair value comprising $28.69 billion, reflecting net unrealized appreciation.
The composition of the investment portfolio has shifted toward a more conservative stance over the last 4 years. First lien senior secured loans now represent 61% of the portfolio at fair value as of September 2025, up from 57% at the end of 2024. This shift is a deliberate strategy to enhance capital preservation in the event of a macroeconomic downturn. By focusing on the top of the capital stack, Ares Capital ensures it has priority over a borrower's assets in a restructuring scenario. The portfolio mix as of September 30, 2025 consists of first lien senior secured, 61%, up from 57% in December 2024, second lien senior secured, 6%, down from 7% in December 2024, subordinated debt, 9%, down from 10% in December 2024, equity and other, 24%, down from 26% in December 2024. The equity component of the portfolio, which stands at approximately 24%, provides a significant lever for net asset value, NAV, growth through realized gains. In Q3 2025, the company recorded $247 million in net realized gains, largely driven by the sale of the Potomac Energy Center, a restructured investment that underscored the company's ability to manage underperforming credits to a profitable exit. Ares Capital maintains a highly diversified portfolio across 34 different industries, focusing on sectors that exhibit less cyclicality and higher recurring revenues. As of September 30, 2025, the primary industry exposures include software and services, 23.2%, healthcare equipment and services, 11.9%, commercial and professional services, 11.4%, financial services, 10.5%, insurance services, 5.9%. The company's software loans are characterized by conservative leverage, with an average loan-to-value (LTV) ratio of 36%. This structural protection is critical as it provides a substantial cushion against valuation volatility in the technology sector. NAV per share is a primary metric of health for a BDC, representing the intrinsic value of the underlying assets minus liabilities. Ares Capital has demonstrated remarkable NAV stability and growth, reaching a record $20.01 per share as of September 30, 2025. This reflects a steady increase from $19.25 in 2023 and $18.41 in 2022. The company's capital structure is balanced between equity and various forms of debt. Key balance sheet metrics include total debt, $13.76 billion as of Q3 2025, compared to $13.759 billion at year-end 2024 and $11.935 billion in 2023. Total equity, $14.322 billion as of Q3 2025, up from $13.355 billion in 2024 and $11.201 billion in 2023. Net debt-to-equity ratio, 1.02x in Q3 2025, which sits within the company's long-term target range of 0.90x to 1.25x. Liquidity, the company maintained $6.2 billion in liquidity as of Q3 2025. The company has successfully utilized at-the-market (ATM) equity programs to raise capital efficiently, generating $1.36 billion in net proceeds through the sale of 65.2 million shares in 2024. This strategy allows for incremental capital raises that are immediately accreted to NII as the funds are deployed into the existing deal pipeline. The sustainability of the dividend is not dependent on positive FCF, but rather on net investment income and the spillover taxable income. Ares Capital has maintained a $0.48 per share quarterly dividend throughout 2024 and 2025. As of late 2025, the company estimated a taxable income spillover of $878 million, or approximately $1.26 per share, providing a buffer that covers more than 2 quarters of dividends. This cushion allows the company to maintain its payout even during periods of temporary earnings volatility. Valuation analysis. Evaluating Ares Capital requires a multi-dimensional approach that considers its earnings power relative to its peer group and its historical valuation ranges. The stock has traditionally traded at a premium to its NAV, a reflection of its market-leading scale and the perceived quality of its management. Valuation metrics. As of early 2026, Ares Capital's price-to-earnings (PE) ratio stands at approximately 10.44x, which is roughly 18% lower than its 10-year historical average of 12.75x. This suggests that the stock may be undervalued relative to its historical norms, particularly given its consistent NAV growth and dividend stability. Valuation: early 2026, PE ratio 10.44x for ARCC, price to book P to NAV 1.05x, dividend yield 9.19%. Ares Capital's price to book P to B ratio of 1.05x indicates that investors are willing to pay a 5% premium for the Ares platform. In comparison, higher growth BDCs often trade at premiums exceeding 1.40x, while those with higher credit risks often trade at discounts to NAV. Risk assessment. While Ares Capital is a blue-chip BDC, several systemic and idiosyncratic risks could impact its performance as it enters 2026. Interest rate risk and spread compression. The most immediate risk is the transition to a lower interest rate environment. With 71% of the portfolio consisting of floating rate loans, a decline in benchmark rates directly reduces interest income. While interest rate floors provide some protection, a sustained decline in SOFR could lead to a contraction in core earnings. Furthermore, yield spread compression, the narrowing difference between the interest charged to borrowers and the company's own cost of funding, accelerated in late 2025. Credit risk and non-accruals. Ares Capital invests in middle-market companies that are often more susceptible to economic downturns than their large-cap counterparts. As of September 30, 2025, non-accruals, loans that are not currently paying interest, were 1.8% of the portfolio at amortized cost and 1% at fair value. While this is below the company's post-global financial crisis average of 2.8%, any broader deterioration in the U.S. economy could lead to an uptick in defaults. Specific borrowers on non-accrual in late 2025 included Eagle Football, $57.2 million subordinate loan, and VProp Operating LLC, $31.1 million first lien loan.
Payment-in-kind income concentration. Payment-in-kind income, where interest is added to the principal balance of a loan rather than paid in cash, accounted for approximately 15.5% of annual income in 2024. While payment-in-kind can be a useful tool for providing liquidity to high-growth companies, a rising ratio can be a warning sign of borrower distress. Ares Management has noted that 57% of their payment-in-kind income in 2025 was derived from dividends on equity investments rather than interest on debt, suggesting it is a function of the company's equity co-investment strategy rather than credit weakness. Macroeconomic and policy uncertainty. The potential for new trade policies and tariffs presents a risk. While many portfolio companies are domestically focused, those with international supply chains could face margin pressure. Additionally, uncertainty surrounding fiscal policy and the direction of short-term interest rates can lead to a slowdown in M&A activity, which reduces the company's ability to generate structuring fees.
The bear case: margin erosion and credit cycle maturity. NII normalization. Analysts project NII to decline from its peak as interest rates fall. If earnings estimates continue to be revised lower, the stock may struggle to maintain its current premium to NAV. Asset quality normalization. Non-accruals are currently near historical lows. A regression to the mean would involve higher realized losses, impacting NAV per share. Spread compression. Intense competition from other private credit funds and a recovering syndicated loan market could force Ares to accept lower yields on new originations. Valuation ceiling. With the stock already trading at a premium to NAV and a PE above its 5-year average, returns will likely be driven almost entirely by the dividend yield rather than price appreciation. The bull case: continued leadership and market consolidation. Scale advantage. With $28.7 billion in investments, Ares can lead larger and more complex financing transactions than almost any other BDC, allowing for better diversification. Dividend fortification. The $1.26 per share spillover income ensures that the dividend is safe even in a recessionary environment, making ARCC a premier defensive income stock. M&A rebound. A lower rate environment in 2026 is expected to stimulate private equity buyout activity, leading to high-quality origination opportunities and structuring fees. Realized gain capability. The company's track record of generating realized gains from its 24% equity and preferred portfolio provides a secondary engine for NAV growth.